Welcome back to Switzer on Australia's Business Channel. It's been a pretty good year for property investors, and so what lies ahead for this financial year? To get a view from a man who lives and breathes the bricks and mortar space, we have the CEO of the listed Centuria Capital Company, John McBain. John, how are you?
Hi, Peter.
You also breathe horses occasionally as well, don't you? It's not all bricks and mortar, but
Correct.
It's fairly important. And it's been a good year for property, hasn't it?
Very good. Yeah, better for property than horses.
All right. For people who haven't come across your company, explain Centuria Capital.
So we have two main divisions, Property Funds Management Division, where we create investments, generally commercial properties, and an investment bond division. Both roughly the same size, just under $1 billion worth of assets. We have two other non-core divisions, but they're our main operating divisions.
Okay. Talk about the first part of your business.
So the property funds business, we've been developing this for 18 years. Up to date, it's all been unlisted property funds, either single properties or two or three properties together, office blocks or industrial type of investments, quite high yielding. So we look for large tenants, long-term leases, and we try and aim for returns in the yield returns in 8 or 9%. That's a little bit hard in today's market because prices are increasing so quickly. But we've made some excellent investments over the last 2 or 3 years.
And so effectively people who are looking to do that kind of investment, you might identify a building. I remember you guys had a building out near Everleigh where Channel 7 is.
Correct. We own half of the Channel 7 headquarters there.
Okay. And then you basically run it as a business, and the profit that you make out of that rolls into Centuria Capital, and that's what people can either invest in via the stock market, or they can invest with you with larger amounts of money in those sorts of buildings, right?
That's right. So our property funds at the funds level collect rent and distribute profits to their investors. We take a fee for managing that, which comes up to the group which I run.
All right. Now, do you only stick to one type of property investment, or if you see an opportunity in commercial, you'll go commercial? If you see one in, say, retail, you'll go retail? Or is there a specific area that you guys play in?
Well, we're very much guided by what the market's doing at that time. And as you said in your introduction, that's all we do. Most of our investments at the moment are office investments, and we specialise in metropolitan office, but latterly we've had investments, major investments in Spring Street in Sydney.
The CBD stuff.
We like that.
And Sydney's got a good outlook?
We like Sydney and we like Melbourne at the moment.
Okay.
Where we see industrials that we like, we will buy them, but they're pretty hotly contested. But we do have them in our portfolio. And retail, we think there's some opportunities in retail at the moment, so we're dabbling in that as well. Okay,
so your overall feeling for the year ahead, because as I say, it's been a pretty good year for property, the REITs have proven that, but what's your feel for the year ahead?
Well, we've had a lot of offshore buying, and that's forced prices right up. Capitalisation rates are now, there have been sales in the Sydney CBD of just over yields of 5%, and for your viewers that means that the same amount of rent's creating a higher capitalised value, making it hard for us to compete and still return a meaning. So
it's good for the stuff you might sell eventually, but it's hard for you to get new stuff.
Yes, so we've been doing some weeding, and we've been selling some of the older stock we might have held for 10 years and making incredible profits for our subscribers, investors, and then replacing them with larger CBD or close to CBD assets like the Channel 7 asset. That was a $100 million asset, for example. Okay, so now let's go to the other part of the business, and that is, I know you've got a thing called the TaxAstute Bond. That is an unusual name. To try and sell anything with the word tax in it is a very interesting play. So tell us what it's about. Well, really the other part of our business is perhaps not as sexy as the property funds management business, but it's an extremely good business. It's a very important part of our group. So we have an APRA licensed subsidiary called Centuria Life, and we can issue bonds which can invest in a range of underlying assets. So, and these are long-term savings vehicles. So probably the closest thing your viewer can compare it with is superannuation. While superannuation is compulsory, these bonds are not. However, there are some important differences. So the bond we've just released last week, in fact,
right.
is the first bond in this series, which is a Centuria credit bond.
Right.
It only invests in fixed interests, investment grade underlying assets, and it's managed by an investment manager, Mason Stevens, which we have a lot of time for. Now, people can put money into this bond. There's no restriction, as there is in super, to how much money you can put in.
Right.
If you put it in and hold it for 10 years, during that 10 years, none of the returns form part of your tax return. If it's very flexible, if, for example, you need the money out for some reason, you can take it out. So there's no issue.
Would you be affected by tax if you break the 10-year?
Yeah, so if you break the 10-year rule, up to 7 years, you'd get a tax credit for the tax we've paid. We pay tax within the bond at 30 cent, or the corporate tax rate, less any tax advantage or franking we receive for investments within the bond.
You'd shrewdly use the tax legislation legally to reduce your tax bill.
Yeah, and I think that's an important point. This is a very old, established product. This product was there long before superannuation.
It's the old insurance bond.
It's the old insurance bond. And what people, I think what has happened now, we've effectively got a position where if you look at the temporary 2% tax surcharge and a little bit of an increase in Medicare levy, and we're almost taxed at 49%. If we can deliver a tax rate for people internally for money they want to set aside for 10 years, now whether that's young people saving for a house or older people wanting to put a nest egg together, that's really a 20% advantage.
All right. Now, if people put their money in, they don't. When do they get their distributions?
Well, distributions compound within the product.
So you're away for 10 years. So it might be perfect for someone who's 55, retiring at 65, and say, let's just whack some money in there and just let it roll over.
Oh, there's lots of examples. That's one really good example. And don't forget, it's not like superannuation in this regard. If you're 55 and then you have a medical emergency when you're 60, you can simply take out the bond value, which will be the capital you introduced, plus the growth. And we return that value within, I think, 7 business days.
Okay. You said investment grade. A lot of people don't understand what that means. What kinds of bonds are you investing inside this overall bond? Okay.
The first, we intend releasing a series. So, of course, this one only invests in fixed interest securities. So these are a high grade. So investment grade is an internationally recognised standard.
Are they corporate bonds and government bonds?
They can be corporate. They're unlikely to be government bonds. They'd be slightly high rated. So to give you a feeling for returns, the target return for this bond is the RBA cash rate plus 3.5%.
So about 6 there at the moment, 2.5 plus 3, about 6%.
So if you take that...
So you'd be going after some of the bank hybrids. Would they work for you?
They can. The manager can move in and out of underlying investments quite freely. Sometimes they would be priced correctly, and they've got the experience to sell or purchase them at the right time. But if you compare them with a term deposit from a bank where you're receiving in that 3-ish% and you're paying tax at 49 or 48 point whatever cents, it starts to make money. For that money, that might be... Another example would be, well, I've put all I can put into super now. What else can I do with my money, which is completely legal? And I can get a 20% tax.
A self-managed super fund buying these inside the super fund?
Well,
there's nothing stopping them.
It doesn't stop them. It's not really targeted that way.
No.
Yeah.
Well, I thought some people at home would be thinking.
Yeah, we think it's generally, we would say everyone has to be in superannuation. It's the law. But what happens when that finishes? Successive tightening of the superannuation regulations means you can put less in. Pension dates are going out. We're not even sure if superannuation vesting dates might go out. And people are getting worried about this.
So John, do people have a window on how the bonds performs each year?
Yeah, they're very regular reporting. And they can see exactly what the returns are. Last financial year, this bond returned about 9.3%.
Okay.
So there was of course, that's not a guide to future performance, as we all say on
Is it possible they could lose a lot? Is it possible?
Look, anything's
Great Depression could
possible.
do that?
These are not capital guaranteed. But you have
You are offering a higher return. When you offer a higher return, it's a little bit more risky. But clearly, in going for investment grade, you're going for companies that are lower risk compared to the high risk ones.
Oh, major corporates.
Yeah.
So, major
Okay,
corporates.
mate. Fantastic. Thanks for joining us. You're reporting soon. I know you can't comment on that, and let's hope you do well.
Well, we're meeting our budgets.
Okay. That's about all you can say ahead of a reporting season.
Yeah.
It's good to see you, mate.
Thanks a lot.
So that's John McBain, CEO of Centuria Capital. Coming up next, we'll see whether